Seema, we'll start with you with the overall read on whether or not the producer price index data will shed any further light on the inflation picture beyond what we saw with CPI. Could it be considered a leading indicator?
Well, thanks for having me on. Well, the PPI is going to be important. Certainly, we put more focus on it than we did pre this inflation resurgence. The one thing that we'll be looking at is going to be trying to deep dive into what are the components which could impact the core PCE, knowing that the Fed is really focused on that. Generally, though, I think the trend that we're seeing over the last couple of months is fairly clear. There is a softening inflation pace. We're looking at, I think, quite optimistic hopes at the moment of getting towards the 2% level, but clearly there is a deceleration which the Fed will be very, very encouraged by.
Okay, so if that's the case, Annika, if you look at the way that the markets have been reacting on balance for the last several weeks at this point, given the economic data that we've seen, things still appear rosy for the most part. We're seeing some cooling off in certain parts of the market. But are you seeing anything that's disturbing to you about some of the rotation, or at least mini rotations that we've been seeing with regard to certain parts of the equity markets?
Yeah, I think the biggest worrying signs of the market, I think it's two things. One, we have become absolutely obsessed with these short-term monthly inflation prints. And, yes, the print was potentially better than expected because it was in line with what expectations were. And that's already better than expected. But let's constantly remind ourselves that a core CPI reading north of 4% is significantly above that 2% mark. Let's remind ourselves of the fact that whilst all this hawkish behavior has been going on, the labor market has stayed very, very strong and the economy has stayed very strong. And let's figure out why. And let's put more time on that. So I think that's one area. And I think the other area is obviously the trickle through effect, the transmission mechanism of interest rates going up. That takes 12 to 18 months to work its way through. We're still not there yet. And if you compare that to equity risk premia in the markets, which is very, very narrow, that does raise some alarm bells.
It does. And maybe that's one of the reasons why, among many factors, that we are seeing some of the valuations, especially in technology, come down to the way that they are. But it's not all of technology and tech-related stuff, Seema. If you take a look at some of the parts that are outperforming over the shorter term, it's still communication services. We're talking some of the bigger names in that as well. Is that something that should be maybe something the bulls can hang their hats on, that we aren't seeing as much of a decline in some of those media-related names out there?
Well, I think that's an important point. What I think investors are doing is they are looking at valuations, and they I think, readily admitting that a lot of valuations are very frothy. The thing with communications and also technology, given the very close relationship with many of them, is that they're still focusing on AI and what the potential productivity gains will be. Now, inevitably, the structural forces can be very strong until the cyclical maybe gets a little bit too much in the way. So as Annika was just laying out, inflation is still very elevated, which means that bond yields may come down a little bit as you get slower economic growth, but they're not going to come down too much. So for a lot of these firms, especially the growthy ones, they will be pressured. So for us as investors, this probably isn't the best time to be adding exposure to a number of those stocks. You want to be looking a little bit further out, maybe really focusing on things such as quality, which are the companies which will continue to have pricing power even as the economy slows. So there's a slight slant in the way that people should be focusing on how to invest going forward.
Seema, could I just follow up on that with you? Where exactly then are the most attractive parts in this market right now, given that construct that you've just laid out?
Yeah, so it's a good question. So from a sector by sector basis, there's actually, I think, little in a way to differentiate for many of them. What we're trying to do now is within each sector, trying to dig a little bit deeper. This is where analysis becomes incredibly important. Active management should hopefully enable us to look out for where the opportunity sets are. But as I said, it's really about quality. Which are the big balance sheets? Which are the companies that can withstand a lot of the economic pressures that we do expect to build up over the coming quarters? And as I said before, pricing power is really going to be key. Inflation is coming down, which means that companies are no longer able to hide a lot of the price increases that they've been throwing onto consumers. So those are the kind of things that I think investors should be looking out for, rather than really focusing on a sector by sector comparison.
Okay, so maybe a little bit more in-depth analysis there. Annika, we'll give you the last word here. What are the most attractive and unattractive parts of the market to you right now, given what you're seeing?
I completely agree with what Simo said, and we've actually dubbed it an investment manifesto. So let's not talk about sectors, let's talk about specific business models, and let's look for three things. It's that simple. Look for a very strong USP, which means strong competitive positioning, market share, pricing power. Number two, look for a very strong focus, companies that are focused on specific areas where they have expertise. And number three, back management teams that are aligned with you as a shareholder, be it the fact that they're shareholders themselves or their bonuses are on the right metrics in the P&L, so they don't do stupid things. That's the way forward, which of course takes more work, but hopefully yields a lot more return and value.